All right, listen up. This isn't some casual talk. Think of this as the final briefing you get before you step onto the battlefield and risk your own money. We're going over Mansi's blueprint, and these are the non-negotiable rules of trading.
Let's get one thing straight right now. The market? It couldn't care less about your gut feeling or that hot tip your buddy gave you. The only thing it respects is discipline. You've got to burn this idea into your brain because, honestly, it's the bedrock of your entire trading career.
Okay, let's start with Section 1, the universal filters. Before a stock even gets on your radar, before you even think about clicking buy, it has to pass two critical tests. Fail one, and it's out. Simple as that.
All right, rule number 1, your absolute first line of defense, the 200-day simple moving average. Here's the deal. A stock must be trading above its 200-day SMA. Why? Because that line is where the big money, the institutions, see the long-term trend. Trading below it is like trying to swim upstream against a raging river. We don't do that. We swim with the current. This one rule will save you so much pain you have no idea.
Next up, volume confirmation. Look, price can wiggle around for all sorts of reasons, but when a price move happens with a huge spike in volume, that's different. That's conviction. That's the market screaming, "We mean business." Without that big volume kick, any signal you see is just noise, and we are not in the business of trading noise.
Okay, Section 2, your 3 entry signals. So, a stock has passed both filters. It's above the 200-day and you're watching for volume. Great. Now there are only 3, and I mean only 3, approved ways you're allowed to enter a trade.
Here they are. Number 1, at support. Number 2, at breakout. And number 3, extremely oversold. You need to get these tattooed on your brain. As a novice, you're going to focus on mastering the first 2. Trying to get creative and deviate from this plan, that's not being a maverick. It's just the fastest way to zero out your account. Don't do it. And just in case it wasn't crystal clear, let me say it again. This is the golden rule. Volume confirmation is mandatory for all 3 entry types. I don't care if the setup looks like a textbook picture of perfection. No volume spike, no trade. It's not a real signal, it's a trap. Period.
So let's drill down on that at support entry. We are not gamblers trying to catch a falling knife. We wait for proof. We need to see a specific bullish candle form right at that support level. What are we looking for? Either a bullish engulfing pattern, where a big green candle just completely swallows the previous red one, or a hammer, that little candle body with a long tail. And here's the key part. Even when you see it, you don't jump in. You only enter after the price breaks above the high of that confirmation candle. We need that extra confirmation.
Now, what about the at breakout entry? This is where so many beginners get burned because they're impatient. A real trustworthy breakout only happens after a period of consolidation. Think of it like a spring coiling up. We need to see the price go sideways in a tight range for at least 3 candles. That's the minimum. The longer it coils, the more power is building up for the big move. We wait for that tension.
Okay, let's talk about that third entry, extremely oversold. And I need you to listen very carefully. For you as a novice trader, this method is off limits. It's forbidden. Don't even think about it. Trying to play this game without years of screen time is like stepping into the ring with a heavyweight champ. It's a fatal mistake. You'll get destroyed. Stick to support and breakouts. Got it?
All right, on to Section 3, the survival rules. And this right here, this is your most important job. Your goal right now is not to get rich quick. Your number 1 job is to survive, to protect your capital so you're still in the game tomorrow and the next day and the day after that.
And for those of you who are novice intraday traders, these rules are absolute. Think of intraday trading as your basic training. It's fast, it's intense, and it will chew you up if you're not careful. The next 2 rules are the guardrails. They're what keep you from driving right off a cliff.
Here's the first one, and it's set in stone. On any single intraday trade, you will never lose more than 0.25%. That's a quarter of 1% of your total capital. You calculate your position size based on this before you even think about entering. There is 0 wiggle room on this, 0.
And the second absolute limit? 2. You will never take more than 2 intraday trades in a single day. I don't care if you won both and feel like a genius, or lost both and want revenge. After 2 trades, you are done. Shut it down. This rule is a circuit breaker for your emotions. It stops you from overtrading when you're euphoric and revenge trading when you're angry. The 2 things that kill new traders.
Okay, let's move on.
Section 4. Trading Styles Compared. So we've covered the universal filters, the entries, and the intraday survival rules. But what happens when you're swing trading or positional? The rules change. Let's break down the playbook for each style so there's absolutely no confusion.
Take a good look at this table. You need to know this inside and out. Notice how everything changes based on the style. For intraday, your risk is super tight, right? A tiny 0.25% max loss, just 2 trades a day. But look at swing and positional trading. Your max loss per trade bumps up to 1%, and you can manage up to 7 open positions at once. And see the time frames? You're looking at a daily chart for the main trend. Then you've got long-term trading, where the risk per trade is much wider at 7%, but you're only holding a few positions, maybe 4. You have to know which game you're playing and follow its specific rules.
And that brings us to our final section, Section 5, the investment mandate. Look, trading is fantastic for generating cash flow, but investing is the end game. This is how you build real, long-term, generational wealth, and it demands a totally different mindset. So what's the bedrock of that long-term portfolio? It's this. A minimum, and I mean an absolute minimum, of 50% of your investment capital must be in ETFs and very large cap stocks. These are your core, stable holdings. This is the foundation that everything else is built on. It's not the exciting part, but it's the most important part. So the big question is, when do you sell these core investments? The answer is incredibly simple, but it takes a lot of discipline to follow. You exit only when the fundamental reason you bought it in the first place has changed for the worse. We don't sell because the market had a bad week or some talking head on TV is screaming, "Sell!" We ignore the short-term noise and play the long game. That's it. So there you have it. The blueprint is right here in front of you. The rules couldn't be clearer. They've been tested and they work. The only variable left in this whole equation is you. Do you have the discipline to follow these rules day in and day out on every single trade without exception? That's the only question that matters now.